January 19th, 2026. While financial markets opened this morning, a directive was signed in Washington, buried inside Defense Appropriations, Section 1047, $2.5 billion. Authorized, not for tanks, not for missiles, for silver. The United States government just became the largest non-price sensitive buyer in a market where registered inventory sits at 40 million ounces and delivery obligations exceed 200 million. By April, someone will not receive their metal. The only question is, who breaks the contract first? Welcome to Currency Archive. For those of you joining us for the first time, this is where we document the economic events your portfolio manager isn't discussing with you. If you've built wealth over decades, if you understand that markets don't collapse, they restructure around those who see the shifts early, then consider subscribing. We're not here for entertainment, we're here for preservation. One click, that's all it takes to ensure these analyses reach you before the headlines do. And tell us, where are you watching from today? New York, London, Dubai, Singapore? Drop your city in the comments. Let's see how global this audience truly is. Now, let's examine exactly what happened in Washington, and why April isn't just another month on the calendar. On the morning of January 19th, 2026, currency traders across 3 continents opened their terminals to what appeared to be routine market data. Silver was trading at $93 per ounce on the COMEX. Shanghai showed a premium of $15.73. The spread between East and West had widened again. Nothing unusual, or so it seemed. But while traders were analyzing charts and calculating arbitrage opportunities, a document was making its way through secure channels in Washington, D.C. A document that would fundamentally alter the mathematics of the global silver market? Most analysts that morning were focused on the Shanghai premium. They were writing reports about Chinese export restrictions. They were discussing Indian jewelry demand and the growth in solar panel manufacturing. These were legitimate factors, real variables affecting supply and demand, but they were looking at the leaves while missing the forest. The real story was not happening in Shanghai. It was not happening in Mumbai. It was happening in a legislative chamber in Washington where most silver investors never think to look. Buried deep within House Resolution 8282, the Defense Appropriations Act for fiscal year 2026. Section 1047 contained language that most congressmen probably never read. 17 lines of text. Dry. Technical. Boring to anyone not paying attention. But those 17 lines authorized something that had not happened in the United States in over 4 decades. The Secretary of Defense was granted authority to acquire critical minerals for the Strategic National Stockpile. The appropriation amount, $2.5 billion. And at the top of the acquisition list, classified as Tier 1 priority alongside lithium and rare earth elements, silver. Now, to someone unfamiliar with commodity markets, $2.5 billion might sound modest. The U.S. government spends more than that on a typical Tuesday afternoon. But here is what separates those who understand markets from those who merely watch them. The silver market is not measured in trillions, it is measured in millions of ounces. Global annual production of investment-grade silver sits at approximately 200 million ounces. At current prices of $93 per ounce, $2.5 billion represents roughly 27 million ounces. That is more than 13% of total annual production, but the real issue is not annual production, it is available inventory. The COMEX, the New York Mercantile Exchange, where most Western silver futures are traded, operates on a 2-tier inventory system. There is eligible inventory, metal that meets exchange standards but is not available for delivery, and there is registered inventory, metal that is specifically allocated for delivery against futures contracts. As of this morning, registered COMEX silver inventory stands at approximately 40 million ounces. Let that number settle for a moment. 40 million ounces available for delivery. And the United States government just authorized a program to acquire 27 million ounces. That is not a purchase. That is a claim on 2/3 of available delivery stock. But it gets worse, because the U.S. government is not the only entity with claims on that inventory. There are commercial hedgers, mining companies that sold forward production, industrial manufacturers who locked in supply contracts, exchange-traded funds with delivery obligations, and sovereign wealth funds from 3 continents all holding contracts that promise physical delivery. The mathematics simply do not work. When a hedge fund buys silver, they are price sensitive. If the price moves too high, they stop buying. They have risk managers, compliance departments, profit targets. They care about returns. But when the United States Department of Defense buys silver under a national security mandate, price becomes irrelevant. They are not trying to make money. They are trying to secure strategic resources. If silver is at $93, they buy. If it hits $150, they buy. If it reaches $200, they still buy. Because the authorization comes from Congress, The mandate comes from national security assessments, and the funding comes from appropriations that do not require quarterly earnings reports. This is not speculation. This is sovereign accumulation. And history has shown us what happens when governments begin treating industrial commodities as strategic assets. In 1973, the United States established the Strategic Petroleum Reserve. Within 18 months, oil prices quadrupled. In 2010, China imposed export quotas on rare earth elements. Prices increased by 400% in 11 months. These were not coincidences. They were structural responses to sovereign intervention in limited physical markets. Silver is now entering that same category. The business community needs to understand what this means. When governments move into commodity markets with non-price sensitive buying, they do not participate in markets. They distort them. They remove supply from commercial circulation. They create delivery bottlenecks. They force market participants to choose between fulfilling contracts or triggering force majeure clauses. And that choice, that decision point, appears to be arriving in April, because Section 1047 does not just authorize spending. It mandates delivery timelines. The language specifies that critical mineral acquisitions must be completed and delivered to designated federal storage facilities by the end of the second quarter, 2026. That means April, May, June at the latest. 90 days to source and deliver 27 million ounces of physical silver into a market where registered inventory is already stretched thin. The countdown has started, and most investors have no idea the clock is even running. There is a warehouse in Wilmington, Delaware. Most people drive past it every day without noticing. It sits between a FedEx distribution center and a tire factory. Gray walls, barbed wire, security cameras, nothing remarkable. But inside that warehouse, stacked on industrial shelving, sits something that will determine whether thousands of contracts across 3 continents survive or collapse. 38,000 silver bars, each one weighing 1,000 ounces, 38 million ounces total. And every single bar has already been promised to someone else. Some bars are claimed by pension funds in Norway. Others belong to manufacturing contracts for solar companies in Germany. A few thousand are allocated to ETF redemptions in London. And now, the United States government wants 27 million of them. This is not a market anymore. This is musical chairs with metal. And the music is about to stop. Let us rewind 6 months, October 2025. A purchasing manager at a solar panel manufacturer in Arizona sits in her office reviewing supplier contracts. Her company needs 12,000 ounces of silver per month to maintain production. Silver is trading at $78, 72,000 ounces, delivery guaranteed between March and May 2026. Contract signed, a problem solved. She moves on to the next item on her checklist. But what she does not know, what she cannot know, is that the bullion dealer who sold her that contract does not actually own 72,000 ounces. They own a futures contract, a paper promise, that says they can take delivery from COMEX whenever they want. This is how commodity markets work. It is efficient. It reduces storage costs. It provides liquidity. Until it does not. Fast forward to today. That same bullion dealer receives the purchasing manager's delivery request. March 15th, 72,000 ounces. As contracted, the dealer goes to COMEX to exercise their futures contract and take delivery. But when they check the delivery queue, they see something that makes their risk officer's face go pale. There are already requests for 18 million ounces ahead of them in line, and registered inventory. The actual metal available for delivery is at 40 million ounces. The dealer does the math. If the U.S. government takes 27 million ounces, and existing commercial claims take another 18 million, that is 45 million ounces in demand against 40 million in supply, someone is going to get a phone call they do not want to make. Now here is where force majeure enters the equation. Every commodity contract contains what lawyers call an impossibility clause. It says that if delivery becomes impossible due to circumstances beyond reasonable control, acts of God, government action, war, the contract can be terminated without penalty. The party that cannot deliver pays a settlement fee, usually based on market price, and everyone walks away. It sounds fair, but there's a problem. What happens when everyone invokes force majeure at the same time? Because that bullion dealer in our story, they are not alone. There are 43 other dealers, refiners, and commercial participants who all made similar promises. They all sold contracts, assuming they could source metal from COMEX when needed, and they are all looking at the same inventory numbers. 40 million ounces available, 73 million ounces promised. This is not a shortage. This is a structural impossibility. And here is the truly dangerous part. The first dealer to invoke force majeure gets out clean. They call their client. They explain the situation. They pay a settlement based on current market prices, maybe $95 per ounce. Painful, but survivable. The second dealer to invoke force majeure, same story. But by the time the 10th dealer makes that call, the market has figured out what is happening. Buyers realize that contracts are not being honored. Panic begins. Everyone who holds a paper contract starts demanding physical delivery immediately. The price of actual metal, the stuff you can hold, separates from the futures price, what traders call basis blowout. In normal markets, the difference between paper price and physical delivery price is maybe 50 cents. During the 2008 financial crisis, that spread hit $8. During the pandemic silver squeeze in 2021, it briefly touched $14. But what is coming in April? This is different, because this time, it is not retail investors causing the squeeze. It is the United States government, with a $2.5 billion mandate and a delivery deadline written into federal law. They cannot accept force majeure. They cannot take cash settlement. Their authorization specifically requires physical delivery to strategic stockpile facilities. So when 43 commercial dealers invoke force majeure in March and April, when those contracts get cash settled, when that metal stays in eligible inventory instead of moving to registered, the government is still going to need their 27 million ounces. And they are going to go get it, not from COMEX, from the dealers directly, from the refineries, from private storage, using emergency procurement authority under the Defense Appropriations Act. This is the part nobody is discussing. When commercial participants break their contracts, they do not make the government's requirement disappear. They just change who bears the cost. That solar panel manufacturer in Arizona, the one with the 72,000-ounce contract, she's going to get a phone call in March. Here's a cash settlement instead, based on the COMEX price of $93. She takes the money, then she tries to buy silver in the physical market to keep her factory running. The $35 spread between paper settlement and physical reality, that is not market volatility. That is the cost of broken contracts. Multiply that across every industrial manufacturer, every jewelry fabricator, every electronics producer who assumed their contracts would be honored. And you begin to understand why April is not just another month. April is when the music stops. There's a flight that leaves Shanghai every Tuesday at 11:47 p.m. China Eastern Airlines, Flight 288, destination Dubai. For the past 14 months, seat 4A has been occupied by the same passenger, a logistics coordinator for a precious metals trading firm. He boards with a carry-on bag, a tablet, and secure communication equipment. His job is simple. Verify that silver purchased in Shanghai clears Chinese customs, arrives in Dubai, and gets re-exported to European buyers willing to pay the premium. Every Tuesday, same flight, same routine, until 3 weeks ago, January 6th, 2026. He arrived at Pudong International Airport at 9:15 p.m. as usual. Checked in, cleared security, walked to the gate. But when he tried to board, a customs official pulled him aside. Politely, professionally. "Sir, your export license requires additional verification." He showed his documents, all in order, filed months in advance. New protocols. Issued December 28th. All strategic mineral exports now require secondary authorization from the Ministry of Commerce. Processing time, 45 to 60 days. No exceptions. He missed his flight. And he has not made a single delivery since. This is happening across 17 Chinese ports simultaneously. Not a ban, not an embargo, just enhanced verification procedures, but the effect is the same. Chinese silver is no longer leaving China. Now let us talk about what this means for the rest of the world. For decades, commodity traders have operated on a fundamental principle. If silver is cheaper in New York than Shanghai, you buy in New York and sell in Shanghai. This is called arbitrage, and it keeps global prices aligned. When COMEX silver trades at $93 and Shanghai trades at $108, there is a $15 profit opportunity. In theory, a trader should be able to buy 1,000 ounces on COMEX for $93,000, ship it to Shanghai, sell it for $108,000, pocket $15,000 in profit, minus shipping costs, insurance, storage fees, maybe $12,000 in pure profit per 1,000 ounces. This should be free money. And 6 months ago, it was. Arbitrage firms were moving 3 to 4 million ounces per month from west to east. The moment Shanghai's price rose above New York's price, metal flowed east. The moment New York's price rose above Shanghai's, metal flowed west. This kept the spread narrow, maybe $2 to $3 maximum. But look at the spread today, $15.73. That is not a normal market inefficiency. That is a broken mechanism because the metal is not flowing anymore. Not because traders do not want to, they desperately want to, but because 3 separate barriers have emerged simultaneously. Barrier 1, Chinese export licenses frozen. Barrier 2, Shanghai Futures Exchange, now requiring domestic delivery for an increasing percentage of contracts. Barrier 3, and this is the one nobody saw coming. Chinese banks have stopped processing letters of credit for silver exports. That third one needs explanation. In international trade, when a European buyer wants to purchase silver from China, they do not just wire money and hope the metal shows up. They use a letter of credit, a bank guarantee that says, "We will pay the seller once proof of delivery is provided." This protects both parties. But in November 2025, the People's Bank of China issued guidance to Chinese commercial banks. Not a law, not a regulation, just guidance. It said that banks should exercise enhanced scrutiny on transactions involving strategic resources and prioritize domestic economic security in credit decisions. 3 weeks later, letters of credit for silver exports started getting delayed. Then denied. Now, they are simply not being processed. Without letters of credit, international silver trade from China has effectively stopped. So that $15 premium between Shanghai and New York, it is not temporary. It is structural. It represents two markets that have fundamentally separated. But here is where it gets more complex. Because China is not just hoarding silver out of spite. They are responding to the exact same calculation the United States just made. Silver is a strategic resource. It is required for solar panels, for electronics, for military hardware, for 5G infrastructure. China is the world's largest solar manufacturer. They produce 68% of global solar panels. Each panel requires approximately 20 grams of silver. China's domestic solar installation target for 2026, 280 gigawatts. That requires approximately 6,000 metric tons of silver, roughly 193 million ounces. But China only produces 32 million ounces domestically per year. They have been importing the difference until now, because if the United States is building a strategic stockpile, if Western governments are classifying silver as a national security priority, then China cannot afford to let their industrial silver leave the country, even at a $15 premium. This is game theory playing out in commodity markets. Two superpowers, both realizing simultaneously that silver is more valuable as a strategic asset than as a traded commodity, and the rest of the world is caught in between. Consider what this means for a solar panel manufacturer in Germany. 6 months ago, they could source silver from 3 regions: North America, South America, or Asia. Wherever the price was cheapest, today, Asian silver is locked behind export controls. South American silver is being diverted to U.S. government contracts. That leaves North American production, which is already spoken for by existing commercial contracts, and now 27 million ounces of government procurement. The German manufacturer has orders to fill, contracts to honor, production schedules to maintain. But the metal they need, it exists. It is sitting in warehouses. They can see it on inventory reports. They just cannot access it, because it is on the wrong side of a new geopolitical boundary. This is what currency wars look like when they evolve into commodity wars. The dollar versus the yuan, that was phase 1, trade tariffs and counter tariffs. That was phase 2, technology restrictions and export controls, and that was phase 3. Now we have entered phase 4, strategic resource nationalism, where governments decide that certain commodities are too important to be priced by markets, too critical to be allocated by supply and demand, and the $15 Shanghai premium is not a price signal. It is a warning. It is telling us that the global commodity system built over the past 50 years, the one that assumed free movement of materials across borders, the one that assumed markets would always clear at some price, and that system is ending, not someday, now. Because when silver trades at $93 in New York and $108 in Shanghai, and nobody can arbitrage the difference, you do not have one global silver market anymore. You have 2 separate markets, operating under different rules, serving different strategic priorities, and that division, that fundamental fracture in how commodities are priced and allocated, that has consequences far beyond silver. It affects every commodity, every supply chain, every business model built on the assumption that global markets will remain global. April is not just when force majeure clauses start triggering in New York. It is when business leaders realize the world economy has been reorganized, and nobody sent them the memo. There's a conference room on the 43rd floor of a building in Lower Manhattan, floor-to-ceiling windows, view of the Hudson River, mahogany table. 8 people sit around that table every Monday morning at 7 a.m. Chief Financial Officer, Chief Operating Officer, Head of Procurement, Head of Risk Management, their respective deputies. This is the Executive Supply Chain Committee for one of America's largest solar panel installation companies. They meet every week to review material costs, supplier relationships, contract exposures, boring stuff, spreadsheets, vendor scorecards, quarterly projections, until this morning, February 10th, 2026, the head of procurement arrives 7 minutes late. Unusual for him, he is typically the first one there. He sits down without his usual coffee, without his usual morning pleasantries. He opens his laptop, pulls up a single email, and projects it onto the conference room screen. It is from their primary silver supplier, a Swiss-based bullion dealer they have worked with for 9 years. The email is 3 paragraphs long. Paragraph 1 explains that due to unprecedented market conditions and unforeseen government interventions in North American silver markets, the supplier is experiencing significant sourcing challenges. Paragraph 2 invokes Section 12.4 of their supply agreement, the force majeure clause, citing impossibility of performance due to regulatory changes beyond their reasonable control. Paragraph 3 offers a cash settlement for all outstanding forward contracts, based on last Friday's COMEX closing price of $96 per ounce. The CFO reads it twice, then asks the obvious question: how much silver do we have under contract with them? The head of procurement does not need to check his notes. 460,000 ounces, scheduled for delivery between March and August. The CFO does the math in his head. At current contract prices, that is $41 million in committed silver purchases. Their entire material budget for Q2 and Q3 depends on that metal arriving. What happens if we take the cash settlement? The head of procurement pulls up another screen. Current physical silver prices from dealers still willing to quote, not COMEX paper prices, actual metal, with delivery to their facility in Nevada. Spot physical is trading at $132, with a 6-week delivery window, if we can even get it. The room goes quiet, because everyone at that table just did the same calculation. Take the settlement at $96, then try to replace 460,000 ounces at $132. That is a $16.5 million shortfall. That is not a budget variance. That is a material breach of their own customer contracts. They have 19 solar farm projects scheduled for installation between April and September. Those projects were sold based on cost assumptions that included silver at $82 per ounce. If they cannot source silver, they cannot fulfill installation contracts. If they cannot fulfill installation contracts, they pay penalty clauses. And if they pay penalty clauses on 19 projects simultaneously, their bonding company will likely suspend their license. One email, 3 paragraphs, and a 9-year-old company with 600 employees is facing existential risk. This is not a hypothetical scenario. This exact meeting is happening in corporate offices across 3 continents right now. Because what the US government did by authorizing that $2.5 billion procurement, what China did by freezing export licenses, what every silver dealer and refiner is doing by invoking force majeure. It created a cascade, and that cascade is about to reach every business that assumed commodity markets would function normally. Let us be very clear about the timeline. We are currently in the 2nd week of February. The US government's procurement mandate specifies completion by end of Q2. That means June 30th at the latest. But procurement officers do not wait until the deadline. They start immediately, which means between now and April, somewhere between 15 and 20 million ounces need to be sourced and delivered to federal facilities. Every ounce they take comes from the same pool that commercial buyers are trying to access. And that pool, the registered COMEX inventory plus immediately available refinery output, is approximately 55 million ounces over the next 90 days. Demand from government, 20 million ounces. Demand from existing commercial contracts, 43 million ounces. Demand from industrial manufacturers replacing broken contracts, unknown, but substantial. The math does not close, which means businesses face a binary decision tree. Branch 1, secure physical silver now, before force majeure notices become widespread, before prices separate further from paper markets, before suppliers stop quoting entirely. Branch 2, wait, hope their contracts hold, hope their suppliers do not break, hope the situation resolves. This is not investment advice. This is a supply chain decision. And the window for Branch 1 is closing, not in months, in weeks. Because once the first wave of force majeure notices hits in March, once industrial buyers realize their contracts are not being honored, there will be a scramble for whatever physical metal remains available. And at that point, price becomes irrelevant. A solar installation company that cannot source silver cannot operate. An electronics manufacturer that cannot source silver cannot produce. A medical device company that cannot source silver cannot fulfill hospital orders. This is not about making money on silver price appreciation. This is about operational continuity. Let us walk through the decision framework for 3 different business categories. Category 1, industrial consumers with existing supply contracts. The question is not whether to secure additional silver. The question is how much buffer inventory to build before suppliers start breaking contracts. Minimum recommendation, 90 days of production needs, sourced from dealers still willing to provide allocated physical delivery, paid in full, stored in non-bank vaults. Yes, this ties up working capital. Yes, this increases storage costs. But compared to production shutdowns and customer contract penalties, It is cheap insurance. Category 2, businesses with price exposure but no physical delivery needs. Mining companies with forward hedges, investment funds with futures positions, speculators with paper contracts. The critical question, are you holding contracts that promise physical delivery or cash-settled derivatives? If physical delivery, you need to understand counterparty risk. Can your dealer actually deliver if you exercise the contract? If cash-settled, you need to understand basis risk, the spread between paper settlement price and physical replacement cost. Many businesses are about to learn this distinction the hard way. Category 3, service providers in adjacent industries, logistics companies, vault operators, refining facilities, assay services. There's about to be a significant shortage of silver handling infrastructure. When physical premiums spike, when delivery timelines extend, when commercial buyers start competing for limited transport and storage capacity, the businesses that provide those services are going to have pricing power they have not seen in decades. This is not speculation. This is what happens every time physical commodity markets dislocate. The infrastructure providers become the bottleneck, and bottlenecks command premium pricing. Now let us address the question every executive is asking. Could the government just cancel the program? Could they reverse the authorization? Technically, yes. Congress could pass new legislation. The president could issue an executive order. But consider the optics. The United States government publicly announces a strategic mineral acquisition program, classifies silver as a national security priority. Then, when the market reacts, when prices rise, when shortages emerge, they back down. They admit they cannot execute their own procurement mandate. What does that signal to allies about American industrial capacity? What does that signal to adversaries about American strategic planning? The political cost of backing down is higher than the economic cost of following through, which means the program continues, which means the pressure on physical markets intensifies, which means the businesses that prepared early survive, and those that waited do not. April is 51 days away. That meeting in the Manhattan conference room, the one where 8 executives realize their entire business model depends on contracts that might not be honored. That meeting is going to be repeated in boardrooms across the developed world over the next 8 weeks. The only variable is whether those executives are having that conversation before their suppliers invoke force majeure or after. Before, there are options. Expensive options, uncomfortable options, but options. After, there are only consequences. The U.S. government did not create a market opportunity when they authorized that $2.5 billion program. They created a supply chain crisis. And crises do not reward the patient. They reward the prepared.